are live with Ben Black, who is the Chief Investment Officer of Powerlaw Corp, which is a Nasdaq-listed closed-end fund that provides exposure to leading private tech companies through a single publicly traded security, which is really interesting in the era of massive tech IPOs that we've been seeing so far this year and throughout the rest of this year and next. So, Ben, welcome to MTS.
Thanks for having me, Theo. It's great to be here.
Yeah, absolutely. So what exactly is Powerlaw for the audience who might not know? And how is it different from other ways in which individual investors can get exposure in private tech companies?
Well, I'll give you a little bit of the backstory so that the whole story makes sense. So I founded a secondary firm called Acadian Ventures 16 years ago. I'm one of the sort of original secondary guys. And after doing 6 funds in 14 years, 15 years of doing secondaries, we were thinking about, going out for our 7th fund. And I looked around and I said, man, the world is kind of choking on 10-year liquid funds. I looked around and said, there's got to be a better way. And that's when we came across closed-end funds, which have been around for a really long time. They're a publicly regulated vehicle, SEC-regulated vehicle, and have literally been in use since the 1880s. And they're designed to really hold long-term or liquid assets, which is exactly what venture capital assets are. So we decided that instead of doing another 10-year liquid fund, we're going to create this new this new wrapper that's in some ways old, but applied to venture capital assets in a new way, so that we could raise money privately, build a great portfolio of late-stage assets, and then take that company public, so that any investor around the globe that wants to get exposure to these great sort of, the companies we think of the generational names, can buy it with a click of a button in a brokerage account. We thought that was a really amazing solution to sort of the long duration that anyone that's been in venture for any sort of period of time has experienced. So that was sort of the inception. So today it's trading. We did a direct listing. It's been trading for only about two or 3 weeks. We're a brand new public company, but it's amazing to see it out there.
Awesome. So actually, while I was going through my timeline review segment, I saw a very relevant tweet from John Lober, previous MTS guest, who is a, I guess, vague finance and tech guy. And he said basically, a lot of people are proposing that in order to give individual investors access to some of these high return tech companies, we should remove the accredited investor laws. But he said that seems like the worst of both worlds, the opacity and pay-to-play of private markets mixed with the lack of common standards and regulatory watchdogs of public markets. I'm sure that retail would largely lose money as they did in crypto. To resolve this tension, I think the right solution is to make it easy for private companies to go public earlier. That's much better for the public and for the economy than removing accreditation laws. So what do you think about this take? Should we remove?
I think it's a really interesting take, because in a lot of ways the closed-end fund really sort of addresses the core problem. We're professional investors. We've been navigating the secondary markets for 16 years. We're literally experts in how to navigate it, and we do it in a regulated structure with transparency, public company audits. And so the closed-end fund is a great vehicle because any investor can buy it. They don't have to be accredited, but they don't have to go into the private markets without accreditation and be subject to all the chicanery that we know can happen in the private market. So by having that trusted governance and with experienced managers, we think closed-end funds are a great way to provide access to these names. Much better than just having retail investors try to go down and pick SPV managers. That's kind of insane. So we think it's a really good solution.
What do you think about the societal implications of companies staying private for much, much longer? It seems like a lot of people are very concerned about AI. They're very concerned about the permanent underclass. And a lot of these tech companies like OpenAI and Anthropic have gone up to $1 trillion in market cap without actually going public. So all of these returns have so far gone to early employees and insiders and institutional investors.
Yes. Yeah, I think in some ways, we've really broken the social contract with the everyday investors. It used to be, think about with Microsoft, Google, think of Facebook, think about when they went public, think about NVIDIA. Think of how long that was a public company, right? And public investors through index funds could get access to and get exposed to the greatest value creation of our time. And it is now, we all know, like, venture capital, the system is sort of set up to keep these companies private forever. Now, if you're a private company CEO of sort of a generational company, like, being private is awesome. You get all the capital you could want. I helped create the problem, because they, helped create the secondary market. And now you get all the secondary liquidity you want. And there's absolutely no motivation for these companies to go public anymore. And so, largely, like, these large tech IPOs they've really shown how much retail is missing out on. And, I have a personal story on this just to, like, demonstrate it.
Go for it.
I put up a little video yesterday, just sort of congratulating some of my friends in the recent IPOs that have occurred. And some of the comments were just absolutely vicious about, so angry that everyday investors can't get access to these companies. And that's exactly the problem we're trying to solve here. So much of the value creation happens 3, 4, 5 years before an IPO. And, a closed-end fund is exactly the way to get unaccredited investors, really investors of any kind, it's daily liquidity. They don't have to hold it forever. They don't have to go sign, complicated contracts. They can just buy it, be exposed. And we want these things to be long-term value creation vehicles for retail investors and for really any kind of investor.
Mm. So what is a closed-end fund, and how is it different from other ways of getting exposure?
Well, so the 1940 Act created basically the public fund structure that we know. Closed-end funds, interval funds, mutual funds, ETFs, right? And all a closed-end fund means is that you have a fixed number of shares. So you issue a fixed number of shares, and, like, if you're in an ETF, shares can be created, they can be destroyed, just keep all the assets trading in NAV. But if you're dealing with illiquid assets that are only traded on an intermittent basis, that is impossible. So private assets don't work in that format. So closed-end funds, they've been used for everything. I mean, they've been used for people who buy uranium stores. They've been used for utility funds, income-producing assets. And they've been around forever, but the prime use case is exactly this. When you have illiquid assets that are hard to trade and hard to value, it gives any investor the ability to buy it on a nationally listed exchange, the Nasdaq or New York Stock Exchange, with full reporting and transparency. They can get it in it when they want. They can get out of it when they want. And that's sort of this. It's just like it's just kind of like a mutual fund, but just like a subtype, if you will.
Got it. So why is Powerlaw structured as a closed-end fund specifically, rather than an ETF, for example, or just a traditional?
Well, ETF. Yeah. Oh, so traditional venture funds, the problem with them is we all know they're going to last 15, 20 years right now. Like, so a 10-year liquid fund is not the proper vehicle for if people can't take the time duration, right? An ETF, you can't have liquid assets, but a closed-end fund is just fine. You can absolutely hold liquid assets in as long as you need, and they're evergreen. So the assets. So basically, think about it like it's like a holding company that holds all the venture assets, all the shares in the private companies, and the shares trade every day on the public market. So you can go today to your brokerage account, buy shares of Powerlaw. If you like it, you like the companies, you like the portfolio, and then you can sell it after a year, 2 years, 3 years, but you're not locked up for 10 or 15 in the case of most VC funds these days.
Gotcha. So I want to talk a little bit about Powerlaw's portfolio. You said you have SpaceX, OpenAI, Databricks, Stripe, Deal, Kalshi, Kraken, Vast Data, Tethered, so on and so on. A lot of these really cool companies. How did you decide what to allocate the portfolio towards?
Well, we wanted this fund to sort of represent what we think is sort of the best of the best privates. And so we went through, just like any venture capital firm, we went through the whole world of possibilities, and we said, what are the companies that we thought that retail investors would get really excited about, where we thought there was a lot of growth ahead, and we thought that these are just great generational companies that if you hold this portfolio over time, it's going to perform really well. We underwrite just like a VC fund. I mean, I'm a VC. Like we do it just, we're like looking for businesses that are compounding, looking for businesses that are disruptive, and looking for businesses that as a portfolio give a really good cross-section of the venture ecosystem, but it's concentrated. We don't want this to be an index of venture. We want it to be a concentrated portfolio of businesses we believe in over the long term. And our goal is to really create, a community of public investors who want exposure to those types of companies and can just hold on, because we all know how long it takes to get to be a public company these days. And it could be many years. And some of these companies are going to go public sooner. Some of these companies are going to take years. It's a portfolio, and the goal is just nice NAV increase, just like you're a venture capitalist.
Mm. Do you have any exposure to Anthropic?
No, we don't. We don't have that one. So you can't get everything that you want all the time.
Can't get them all. Yeah, that is true. Anthropic is and OpenAI have been like really cracking down on people who hold their stock through these like multi-layer SPVs that seem a little suspicious.
Well, I completely understand it. Like, SPVs are a great tool in the right hands. If you're an expert, you have no problem finding good counterparties, understanding how to read the operating agreement, how to manage the risk about them. The problem is an SPV in the wrong hands is a really dangerous tool, and they're unaudited and things like that. So if you know what you're doing, SPVs are fine, and a lot of people do. And there's great counterparties out there doing them, but they are not for everyone, and this should be handled with care. So there was a lot, as you know, there was a lot of bad behavior out there. I totally understand why those companies would want to crack down on some of the behavior that was going on, and we're completely aligned with that.
Right. So how does Powerlaw acquire stakes in these companies? Is it through like employee secondaries? Is it like venture rounds?
It's everything. We do direct. We do direct to participate in primaries, but we're really good at picking up shares in the secondary market. We've done since we started over 850 secondaries. So basically, we find a company we want. We go to the company, we establish a position, and then we're out there in the secondary market looking for every opportunity to build up in our position over many, many transactions. And that's kind of like, we do that all in-house. We've been doing that for a really long time. And that's how we can sort of create a bespoke portfolio like this that's got so many exciting companies in it. Mm. There's a lot of flexibility when you're a secondary guy. You got two companies that are competitors. No one cares if secondary guys buy them. The primary guys, they get a little sensitive about that.
Right. So before we hop off, last question would be, what is Powerlaw going to be doing next? What are your plans for the future?
Well, so, I think we're at the early days of really a revolution in providing access to late stage privates this way. And I think that once you sort of get your head out of just being stuck in a 10-year liquid fund structure as a manager, the sort of design space opens up. We're going to see all sorts of closed-end funds that have all sorts of different strategies. And, we're really happy we're here right at the beginning to be the first VC fund that's taken a fund public. Because for VCs, we got to get into this game, because if we don't do it, other companies are going to do it. And I think that the VCs should be the managers here, not other, just sort of big companies. And that's our goal, is to build out this space and really make it an institutional quality asset class for retail investors around the world.
Right. Well, I mean, I'm totally aligned with this vision. I think it's going to be awesome when retail investors finally do get to capture some of the incredible returns that we've seen in tech over the last few years. So we love what you're doing with Powerlaw.
Thank you. It's what I wake up every day to do, is to deliver for those investors.
Awesome. Thanks so much, Ben, for coming on MTS.
Thanks for having me. Appreciate it.
Absolutely. And we'll be right back.
Have a great day.